coming out of the heels of a week that saw a huge amount of data and updates across the likes of tariffs, the corporate agenda, and the economic and central bank side of things. This coming week doesn't necessarily have the same amount of key data points, but we still have plenty to sink our teeth into with the Bank of England interest rate decision, the jobs report out of Canada, and the ISM services PMI figure out of the US. Let's look into those figures, understand why they're important, and see how we can trade them. So as ever, we're going to look at the big ticket items according to Trading Economics, kicking off on Tuesday with export and import data from Canada. Of course, that's key at a time where we're seeing the breaking down of their relationship with their number one trading partner south of the border with the US. But the key release over the course of the day is going to be that ISM services PMI figure. It comes in the wake of the ISM manufacturing PMI number. And these ISM numbers are really important, and I'll show you exactly why when we get into it. In terms of Thursday, we've got, again, more trade data, this time out of Australia and China. The Chinese one particularly will be interesting, trying to gauge exactly how the Chinese economy is faring under the weight of tariffs imposed by Donald Trump. See, same kind of thing in terms of Germany, actually. And then we have the UK interest rate decision. Bank of England expected to cut rates by 25 basis points despite the rise in inflation that we've seen of late. And like I said, on Friday, we see the jobs report out of Canada. By and large, we generally see that released at the same time as the US jobs report. That has not happened because we've seen the jobs report coming into play on the 1st. And so a week later, we see the Canadian jobs numbers. We're going to kick off with the UK, the Bank of England rate decision, probably the most notable decision over the course of the week. Now, of course, the UK is in a bit of a pickle, bit of a troubling situation at the moment. We've seen a rise in terms of the cost of borrowing in the UK that has, alongside a number of other elements, including low growth, that has put a dampener on the budgetary constraints for the Treasury. So many of the expectations under which the likes of Rachel Reeves decided her budget have changed, and part of that has been low growth. So you have lower tax receipts, higher expenditure when it comes to benefits. Then you've also got elevated cost of borrowing associated with inflation-linked gilts. And at the same time, you're seeing a rise in terms of unemployment, weakness in terms of the economy at large. So what you want is a government or a central bank that's able to step in and help. But what we see is elevated inflation, which essentially stymies the role of the Bank of England. And on the government side of things, you've got a black hole that needs fixing, which means higher taxes, most likely. And that doesn't necessarily mean that they're suddenly going to come out with stimulus measures. So in a difficult position, and out of the two, it's most likely we're going to see something from the Bank of England. And that's exactly what is expected. You can see here, markets pricing a 25 basis point cut from the BOE, that despite inflation. So really, they're sort of pushing back against the idea that they need inflation to be at 2% because it's nowhere near it right now. As you can see here, headline inflation sort of 3.6%, core inflation 3.7%. They have been climbing of late. And if you look at the monthly breakdown in the middle section here, really much of it came in April, roughly 1% added to headline inflation in that month alone. So the ability to reach that 2% target is difficult when you're hitting 1% on one single month. Much of it came down to a number of different measures all coming into play around the same time, whether it's the rise in terms of the price cap in the UK, whether it's the likes of the national insurance contributions for businesses kicking in, and a whole lot more. Now, in terms of where we have gone since then, well, it's not like inflation is completely under control. You can see June as well, inflation was hotter than we need it to be. And on the 9-month annualized, which essentially says where will we be in a few months' time, you can see both headline and core above 4%. So that doesn't necessarily paint a picture of an environment that's ideal for the Bank of England to be able to cut. But as you can see here, we are seeing a rise in terms of inflation metrics, notably the headline LFS survey. And so the rise in terms of unemployment puts pressure on the Bank of England. Now, like I said, we've got elevated yields in the UK. So the cost of borrowing is elevated in the UK. Part of that will be associated with the actions of the ECB versus the Bank of England. Of course, the ECB has already been cutting a number of times. The Bank of England has been very hesitant over the course of this process, and the inflation data we're seeing at the moment with UK CPI highest of any G7 nation highlights exactly why we have that hesitancy from the BOE. But you can see the spread in terms of the 10-year compared to Germany. You can see the deterioration in terms of that spread for much of Europe, but that's not the case in the UK, in part because of the fact that the ECB has been cutting rates over that period. The Bank of England has not. And so that shows you the cost of borrowing elevated in the UK, and that's a problem for the government and the Treasury. So the Bank of England needs to help the economy, but also needs to help drive down borrowing costs. In terms of market expectations, 82% expectation for a 25 basis point cut down to 4%. Beyond that, you're going to be looking at the next cut coming into play in November time or onwards. That's roughly a coin toss between cutting or not, around about 53%. You can see here that at the moment, markets don't really have a gauge on exactly where rates are going to end up. I guess because there's greater uncertainty looking further out on exactly which direction we go, right? Look at where inflation's going at the moment. So there's a perception that once you get a little bit down the line, right now, can you call whether inflation's going to rise to the point where they might have to pause or they might have to raise rates, first cutting rates? Not necessarily. There's not a great degree of certainty over that. And therefore, what we're seeing here is that markets are pricing like a couple of rate cuts, maybe three. So 1, 2, 3. Yeah. So the bottom end of this, we've sort of got 50% chance of being able to cut rates a third time. But there's a lot of uncertainty, essentially. And so markets will be seeking not only to see whether they cut interest rates, but also get an understanding on exactly what the outlook is going forward in terms of additional easing. Are they going to take a very patient approach, which the inflation data would signal, or are they going to be a lot more accommodative and see through any near-term rise in terms of inflation as being policy-led? Because, of course, we saw that 1% rise in headline inflation in April. You know, much like in the US, there's this whole thing about, will Powell and the FOMC look beyond the tariff fueled rise in terms of inflation, because essentially that's just policy and it's a one-off bump. You could say the same kind of thing when it comes to the price cap for energy, things like that, right? That will drop off. So that's what's going to be really important. Of course, markets are pricing an 82% chance that we do see a rate cut. So that might not necessarily be the big mover per se. Instead, it's going to be a case of looking at the bigger picture and understanding exactly where we go from here. Now, in terms of looking out for how we're going to trade this, I think the key thing to be looking out for here when we're keeping an eye out for the likes of the pound in particular is how's it trading against some of the key currency pairs. And certainly when we're looking out for the likes of cable, I think it's a really interesting one to be following at the moment. So let me just jump onto cable. What we can see here, if we look from the wider perspective, is that we've been seeing this protracted rally, right? And the current move at the moment gives us this bearish engulfing that's about to close out, being the 31st when I'm recording this. So that points towards a possibility of a protracted period of downside coming into play from here. Of course, we saw the FOMC decision recently. They opted to not only pause once again as expected, but Jay Powell essentially said it's not a given that we're going to see a rate cut coming into play in September. So do we see a protracted pause from the Federal Reserve? Do we see the Bank of England indicating that they're willing to continue to step in? That remains to be seen. But certainly with this bearish engulfing looking like it's pretty much dead set, how do things look on the short term? Well, you can say essentially we've got this, let's just see the best way of drawing this, essentially got this sort of head and shoulders formation, right? I mean, I think that's probably, let's see exactly where it's located. It's not there. There we go. So we've got this head and shoulders formation here. Ding, ding, ding. And that's been completed, right? So that signals a potential top coming into play here for the pound. Now, there's a story around a potential bottoming out for the US dollar, which to many is probably more important than exactly what the pound's doing right now. Because if we look at the Dixie, look at this, right, monthly time frame, look at that lovely trend line bounce that is currently playing at the moment. Again, bearish or bullish engulfing on this occasion. So there's a prospect of a rebound for the US dollar. That feeds into the narrative that we could be entering a new phase of weakness here for cable. Is this first sell-off indicative of what's happened in the past? Right, you see that strong initial move, the bearish engulfing, and then we do move lower, but in a more sort of hesitant and cautious manner from there on in. So are we seeing a retracement of this wider rally here? That's the key thing that we're looking out for at the moment. Over the near term, you can see, you can track it on, say, an intraday basis. So that means if we're looking here, there you go. So 132.82. If we rise through that, then the intraday basis starts to break and we start looking like we could rally into a wider move towards the upside. But until that happens, you know, we've broken through that head and shoulders formation neckline, points towards near-term rallies potentially fading once again to continue the bearishness that has been playing out of late. Next up, let's look at what's happening from the perspective of the US. Now, I don't necessarily pretend to make it out like there's a huge amount of data over the coming week from the US that's all going to be market moving, right? I don't know that factory orders will be market moving, or import exports, or ISM, or jobless claims. There's a lot of data points, but many of them are sort of mid-tier. It's not like we're seeing inflation or the payrolls. But certainly they are interesting. And, you know, the focus of Donald Trump on the manufacturing sector and industrials does provide a basis for interest around the factory orders data on Monday. Of course, the fact that he's trying to realign those trade deficits that the US has with many countries means that the import-export and trade balance data will also be key. But I'm going to be focusing in on the ISM services PMIs. Now, I'm on trading economics here. That's what I utilize. And trading economics is particularly good because it gives you a breakdown of all the different metrics. And that's why I like the ISM numbers, right? You get the headline PMI numbers. And if you look into the report itself, you can see some additional data. The ISM numbers, you can see a breakdown straight off the bat on the economic calendar in terms of what's going where. And you can see it's not necessarily as pretty a picture as you would see if you look at the headline numbers. For example, the last time around, 50.8 was the headline services PMI, right? It's in expansion, so it's fine. If you look at the numbers within that, the strongest number that we're seeing there is 67.5, and that's the prices element. So the inflationary side of things is massive, and that's driving up the average. Elsewhere, you can see some strength within business activities and new orders, and this time around, we're expecting to see them tick marginally higher. As you can see there, employment suffering within the services sector, 47.2, expectations of a potential rise on that front. Whether that comes into fruition or not remains to be seen. But certainly if we're looking at the possibility of a strengthening for some of these numbers, which is what markets are predicting here, then that could feed into the narrative around a stronger US dollar, as the Federal Reserve once again don't necessarily have a desperate need to be taking action straight away. If we see expectations for where things go in terms of monetary policy, that then guides us in terms of many of these other markets and how things are going to react. So in terms of the PMI numbers, this is the ISM manufacturing PMI. You can see it's a similar kind of story. It's the prices paid element that is elevated. The rest of it is struggling. And for the services, yes, you have got a couple of them that are still in expansion, aside from the likes of the prices paid element, but certainly prices providing a problem at the moment. So look at the breakdown for this release. It's going to tell you a lot about whether we're continuing to see sort of stagflationary environment. I would say with new orders and business activities coming in strong last time around, you know, that does ease some of the concerns. If we see weakness in terms of this number one, you'll see. So if you see weakness in terms of, say, new orders and business activity, you could see weakness in terms of the likes of gold because of the fact that we're seeing the expectations of increased action from the central bank. So if we look in here in terms of the chart for gold, I just want to jump onto that first and foremost and see exactly how things could play out. You can see here in terms of price action, we've been largely consolidating of late, breaking through trendline support. We've come into this zone of support. Let's just sort of pick up this latest swing low. So you can see here below here, 32.46. You know, whether we're topping out here or not remains to be seen. Certainly the idea that we might have to wait a long time for rate cuts doesn't necessarily favor things. If we see the data coming out weak, that could provide the basis for strength for gold off the back of it. But a lot of it comes also down to the prices paid element. If there's elevated inflation within that, then it might hold off the central bank from taking action. And therefore, you're going to be looking for possibility of gold weakening further. So essentially, more rate cuts are good for gold, less rate cuts are worse. But if you're looking in terms of the data, you have to be able to differentiate between whether we see a strong ISM PMI figure born out of prices paid or whether it's for the economy as a whole. So look into all of the different elements. That should give you a good guide. But as things stand, do I think we've topped out? I think I need to break the 32.46 to gain greater confidence of that. Until then, are we coming into sort of Fibonacci lows, Fibonacci support? Well, we've come through that level. So that's not necessarily looking great in terms of the potential bottom and a potential rebound here as well. If you're following the intraday charts, you can see here that these nice deep retracements are coming into play and then folding over. So over here, similar kind of thing between that 61.8 and the 76.4 Fibonacci level, and then rolling over once again. So keep an eye out for gold. I need to see a breakup through this 33.33, yeah, 33.33, if that's a weird way of saying it, as a key level. If that breaks, then we start looking like we've bottomed out and the bulls are back in charge. Until that happens, the intraday trend is downwards, and if we do start breaking through support at 32.46, it's not necessarily a great sign for the bulls. Finally, let's just jump back into it and see exactly what the state of play is in Canada. Of course, we've got the breakdown in relationships or trade relations with the US. That will be in play on Tuesday when we see import-export data being released. The PMI numbers on Wednesday with the IV PMI figure on Thursday, and then the jobs report coming into play on Friday. Now, frankly, we've seen the Bank of Canada coming out. They decided to keep rates steady. They've warned that they might have to cut again in the future. It remains to be seen, quite frankly. You've seen the correlation between the Canadian dollar and oil provide some strength at times, but a lot of it has been weakness because we've been seeing oil on the back foot. In terms of the jobs report, one key figure to be looking out for is the unemployment rate, certainly well elevated compared to many of their peers. The employment change figure expected to drop minus 15K. So keep an eye out for that in particular as well. In terms of the inflation side of things, average hourly earnings expected to drop this time around. And let's wrap things up by looking at EURCAD. EURCAD, I think, is a particularly interesting chart right now for the fact that we're trading here around this is the monthly time frame, this major resistance level. Let me just get a horizontal drawn on. So there you go. So as you can see here, we've got these peaks that are like January 2016, March 2018, and then at the beginning of 2020 or the first half of 2020, right? So that's around about 1.61. We've rallied into that level and we've immediately started selling off. That points towards a possibility that we see EURCAD rolling over from here. Of course, we need to see something on the near term that gives us greater confidence that's coming into play. For the time being, that's going to be trendline support, which you can see this inside trendline. What was support turns into resistance, turns back into support. That's the kind of area where we've been finding some support thus far. Have we broken out from the intraday trend? Well, it looks like we've seen this sharp decline. Haven't recovered all of that. So certainly greater confidence comes with the 1.592 break of resistance. But we've come into a really interesting area of support when it comes to trendline support. Fibonacci just below that as well. And so the question mark here is, do we see this continue to play out, or does the wider context start to play an important role and signal the possibility of this pair rolling over in a more meaningful manner? That's all for today. I hope this has been useful. As ever, like, subscribe For more content like this, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great weekend and week ahead.